Bob, what are you seeing today, or are you seeing anything today that, rhymes or, potentially looks like some of the dislocations that you saw in '08?
hmm
Are any of those dislocations as serious as they might have been in '08? What are you seeing in today's macroeconomic conditions and the potential for regime shift? And obviously, inflation has a specter that is hanging over the markets. So anything there that you're seeing any corollaries, or is this a little bit unique? What's the same? What's different?
Well, I think a lot of the dynamics that are going on right now that sort of surprised many market participants were the consequence of that GFC period. And in the 15 years post GFC, both in the moment and the 15 years post GFC, I was in the sort of lucky position to work with policymakers around let's say the evolution of the regulatory frameworks, and the incentives really in terms of how to restructure the economy. And basically what happened over the 15 years post GFC up until COVID was we totally restructured the nature of debt in the US economy. Um, it's hard to believe, but back in 2007, 50% of US mortgages were floaters. And average LTVs were between 90 and 100 at the time. Now, both of those things are just non-existent today, right? Essentially, 100% are longer duration, 100% of mortgages are longer duration fixed loans. And LTVs, except in sort of edge cases, are, the 80 LTV loan is the benchmark loan that people take, no negative AM loans or anything like that. That restructuring of the economy is the thing and I should say, and also the banks have been totally restructured as well, in the sense of, there were banks with 3% capital, right? 30x levered on a true equity basis at the time. That doesn't exist anymore. You need 10 to 15% capital to be running a bank these days. So two huge parts of the overall system that have been totally restructured. I think the thing that's created a lot of reduced sensitivity to the economy, to interest rates as a function of that, which I think has surprised a lot of people. And I think the other thing that is very interesting, particularly as it relates to the CRE issue, is I think a lot of people draw a direct distinction between the CRE issue today and the financial crisis. But unless you're sort of in the bowels of how banks work, you wouldn't necessarily see the difference. Both are credit risks.
Right.
There's going to be lots of losses on CRE. No question about it. The question is not will there be losses, just in the same way lots of losses on houses and house lending back in the GFC. The question is not will there be losses. The question is when do those losses have to be recognized? And there's been a total restructuring of banks to basically strip out any risky securities off their balance sheets so they don't have to be marked to market. And even the efforts taken to, let's say, reduce the mark to market approach on bonds also have, is kind of the end of that series of steps. And now we have CRE. Yeah, there's going to be a few $100 billion of losses and they're going to be eaten by banks. But if it takes 15 years to recognize them, like, who cares? So far banks have recognized, I've earned like $100 billion in NIM on these loans and have recognized $1 billion of losses or something. I mean, just like, who cares, right? If it takes 15 years, but that's really important. So people, particularly post SVB, I think missed. They looked at CRE. They said, we're going to have a financial crisis dynamic. To be clear, the Fed missed that. The Fed sat there and said, we're going to have a CRE driven financial crisis in the banks. They missed it, right? They should know better, but they missed it because they didn't understand. Folks didn't understand how the risk exposures of banks have been totally restructured to significantly reduce the risk of a larger scale credit event through levered financial entities.